Welcome back to the Did You Know channel. If you're new here, just a quick heads up. You don't need to watch this video with your eyes. You can simply play it in the background while cooking, driving, or relaxing. For those returning, glad to have you back. Today we're diving into a topic you've probably come across, the massive rise of the Temu app. Maybe you've seen it in ads, or maybe you've even ordered something from it. But what's really behind this whole story? How can someone sell wireless earbuds for just $3 and still make a profit? And more importantly, what does all this mean for those of us watching the market, following investments, and looking at companies as potential opportunities? Now, if we really want to understand the whole Temu story, we have to start with its parent company, the Chinese giant Pinduoduo. They're not just the owners of Temu, they also run the entire operation. And what's interesting is that Pinduoduo didn't just appear out of nowhere. Long before any of us had even heard of Temu, Pinduoduo was already a successful e-commerce platform in China. That success at home gave them the foundation to launch something like Temu abroad. Because let's be honest, starting a platform of this scale takes billions of dollars. And Pinduoduo had that kind of cash. So, instead of taking it slow and careful, they went all in with a massive advertising campaign. I mean, we're talking ads everywhere. Social media, the news, even during the Super Bowl. In 2024 alone, they reportedly spent $3 billion just on advertising in the US. And the result? People fell in love with the app for its insanely low prices and crazy deals. And here's where things start to get really interesting. How is it possible that a company selling products below cost is still reporting such high profits? So, how is that even possible? How can a company report billions in profit while selling stuff for basically next to nothing? Well, that's actually their whole strategy. Temu is knowingly selling at a loss, often on purpose, just to gain market share. It's not a new concept. Startups do it all the time, tech companies too. You lose money first, build your user base, and once you've got enough people, then you start making money. But with Temu, there's an interesting twist. Because when you look at the actual financial results of their parent company, Pinduoduo, you'll see that they're already making serious money. In the last quarter alone, their revenue jumped 44%, and their net profit went up 61%. And over the course of a year, they reportedly made over $15 billion in profit, which, by the way, is $5 billion more than Coca-Cola. And yes, we're still talking about a company that's selling wireless earbuds for $3. What's even crazier is that even though Temu is apparently spending billions on advertising, the parent company as a whole is still profitable. And from an investment point of view, that's where things get really interesting. Because if this strategy turns out to be sustainable, then we're not just looking at some random Chinese app. We're looking at a major player with massive potential. All right? So Temu is selling below cost, spending billions on ads, and their parent company, Pinduoduo, is still making billions. But how does that actually work? Temu itself doesn't make the products, and it doesn't sell them directly either. It's basically just a middleman. A platform that connects buyers with sellers, and that's the key part. Because Temu simply takes a cut from each sale, no matter whether the seller makes money or not. So, if you buy those $3 earbuds, Temu really doesn't care if the manufacturer profits from it. Their earnings depend on volume, not price. The more people buy, the more they earn from fees. That's why they push prices so low. But that brings up a big question. Are the manufacturers even making money on these ultra-cheap products? And if not, why are they still selling them? Honestly, it's hard to find exact numbers, but it's pretty clear that with prices this low, there's barely any margin left. In fact, Temu is known to pressure suppliers to drive prices even lower, regardless of what it does to quality. So, the whole strategy is about scale, sell cheap, sell a lot, and take a small piece from every sale. And so far, it seems to be working. The only question is, for how long? One of the things that takes Temu's entire business model even further is their use of tax exemptions. And honestly, This is something anyone following global trade and investing should pay attention to. In the US, there was a long-standing rule that if you ordered something from abroad and the package was worth less than $800, you didn't have to pay any customs duties, and Temu took full advantage of that. So imagine this. You buy a pair of earbuds from Temu, they ship them directly from China, and since they're under that $800 limit, there's no customs, no extra fees. Simple as that. But if a seller on Amazon buys the same product in bulk, like a whole shipping container from China, that shipment exceeds the $800 threshold, and they do have to pay customs duties. That creates a massive difference in costs. Thanks to that loophole, Temu was able to sell even cheaper, completely legally. Meanwhile, companies like Gap reportedly paid around $700 million in customs duties in 2022. Temu, nothing. But politicians in the US finally started noticing the gap. And the result? Donald Trump removed that exemption for China, which means duties now apply to those smaller packages as well. And that's already had a real impact. Temu orders dropped by 32% after the new rules kicked in. Personally, I think it's just a matter of time before Europe follows. There's already talk of ending those exemptions in the EU too, in the name of fair competition. I mean, how can a European online shop compete when one business pays customs and the other doesn't? When you look at all of this from a cost perspective, the gap between Temu and traditional retailers is honestly massive. Take a company like Gap, for example. In 2022, they paid around $700 million in customs duties in the US. That's no small number. Meanwhile, platforms like Temu and Shine, which ship items individually and use to benefit from tax exemptions, basically paid nothing. But that's just part of the story. These exemptions allowed them to keep prices extremely low, which obviously affects how people shop. Customers go where it's cheapest, and who can blame them? But from a market and competition perspective, that's completely unfair. And this is exactly where things get interesting for investors, because if the rules change, like they already have in the US, it could have a huge impact on margins, revenue, and overall profitability for companies like Temu. So far, they've operated under conditions that gave them a massive edge. But if governments start leveling the playing field, and they suddenly have to pay the same fees as their competitors, that advantage could disappear pretty fast. And we're already seeing signs of that in Europe. The European Commission is actively working on measures targeting Chinese platforms, and the pressure for fair market conditions is clearly rising. So, from an investment standpoint, definitely something worth watching closely. When we talk about Pinduoduo's profits, there's one really important thing to keep in mind. Not everything we see in the numbers automatically applies to Temu. That's because Temu is just one part of the company's entire business. And while the parent company is showing solid profits, Temu as a standalone platform might actually be losing money. And that's exactly what sources from within the company told Wired magazine. According to them, Temu was losing around $30 per order in the US. This was reported in mid-2023. So things might have changed a bit since then, but still, that's a huge loss per transaction. What's likely keeping the whole company profitable is their Chinese business, the original platform built for the domestic market, which seems to be making enough to cover Temu's losses abroad. And if their goal is to dominate the Western market at any cost, that strategy does make sense. You invest heavily, lose money up front, and hope it pays off long term. But here's the big question. As an investor, do you trust these numbers? We're talking about a Chinese company, and let's be honest, the level of transparency just isn't the same as with American or European companies. So, even if the reported results look impressive, you have to take them with a grain of salt, especially when a large part of the business might be losing money, and the thing you were actually thinking about investing in might not be the part that's generating the profit at all. As if that wasn't enough, Temu and its parent company, Pinduoduo, have also faced serious cybersecurity concerns. In 2023, something happened that definitely shook investor confidence. Google removed the Pinduoduo app from the Play Store. Why? According to cybersecurity researchers, the app reportedly contained malware that could bypass phone security, monitor activity in other apps, read private messages, and even change system settings. That's a whole other level of risk. And sure, let's be real, American tech giants aren't exactly saints either. But this kind of issue can seriously damage a company's reputation, especially in the eyes of investors. If a company is suspected of violating user privacy or compromising device security, it can lead to regulatory action, fines, user backlash, and eventually a drop in stock value. So, from an investment perspective, this is another red flag that needs to be considered when looking at Chinese tech companies. Because it's not just about sales numbers and revenue, it's about trust. And once a company loses that, its growth can stall real fast. Looking at all of this from an investor's perspective, it's clear that the Temu case isn't just about cheap shopping. It's a textbook example of an aggressive strategy, one that's laser-focused on grabbing market share, no matter the current profits, product quality, or long-term consequences. In the short term, it looks like it's working. They've gained attention, a massive user base, and tons of orders. But at the same time, there are some huge risks that simply can't be ignored. Changes in customs exemptions, trust issues, privacy concerns, labor conditions, environmental impact. All of these things could directly affect the company's value and stock performance. And that's something every investor should think about before jumping on this fast-moving train. Temu and Pinduoduo definitely have potential, but they're also playing hard, sometimes right on the edge, and maybe even crossing it. From my point of view, this is a company that's worth watching very closely, not just through the ads and flashy deals popping up online, but through regulatory changes, financial reports, and long-term trends. And above all, let's not get carried away by fast growth. Bubbles grow fast too. But not everything that grows quickly is built on solid ground. So, yeah, that's the full picture. Temu might look like just another cheap shopping app, but behind the scenes, it's part of a much bigger, more complex strategy with serious implications for the market and investors alike. If you found this interesting, make sure to stick around. I cover stories like this all the time. And if you've got thoughts on Temu, Pinduoduo, or the whole sell at a loss to win the market game, I'd love to hear your take in the comments. And thanks for listening all the way through. Whether you were watching or just had it on in the background, I appreciate you. See you in the next one.